It's been a wild year in the market so far, but for investors looking to buy the dip, it is still shopping season, especially if you know where to look. Joining us today with a list of 3 sectors set to soar and 1 you want to avoid is Jeff Clark with TradeSmith and Andy Swan with LikeFolio. Jeff, I want to start with you and a look at the market as a whole. Even though we've had a little bounce the last couple of days, still very much in a sell-off trend really since the end of January.
Back in January with the S&P near 7,000, everybody was bullish and everybody was talking about what stocks can we buy? What can we buy? Nobody was talking about the risk side of the equation. And now fast forward to today and the S&P is 400, 500 points lower and everybody seemingly is bearish and nobody's talking about the potential reward of stepping up. And that's why I kind of like the contrarian strategy that we utilize, because it's almost a reversion to the mean type of strategy where we look for situations that are incredibly oversold, where the risk is somewhat minimal and the reward is high, and we look to buy into those. And we look for the opposite is true, where we might look for sectors or individual stocks that are well overbought and the risk is large compared to the potential reward. And so we wind up selling or even maybe trading from a short side on that. And that is how you make money in the stock market. But unfortunately, most retail investors don't think that way. They want to buy the breakout stocks. They want to buy the momentum. They want to buy the popular things. It's contrarian in nature to look for those sectors that are beaten up where the risk is basically wrung out and then buy into that. And that's what I specialize in doing. And I know that's what Andy does as well.
Yeah, Andy, I want to hear your approach when you're looking at these stocks. Jeff had such great information that so many retail investors just look at what's making headlines right now. And what we're going to get to in this list today is basically the opposite of what the headlines are saying right now, opposite of the stocks you'd think about that are getting all of the attention right now. So I'm excited to dive into the list. But first, Andy, I want to hear your perspective as a trader. When you're looking at options and you're looking at this contrarian approach, what do you look for?
Well, one of the things that LikeFolio really specializes in is we track consumer data. So we're looking for, what products and brands actual consumers are starting to buy, starting to love, starting to tell their friends about. And we look for those kind of breakout products that Wall Street hasn't caught on to yet. Or like Jeff's saying, when a product is breaking out, consumers love what they're seeing. Everything's popping on Main Street. And for some reason, Wall Street hates the stock. That's the contrarian play we love the best. We call that a divergence opportunity. And those are starting to pop up left and right now because the stock market's been beaten down a little bit. But inside of that market, there are lots of opportunities where the consumer, the buyer of these products can't get enough. The company can't make enough product. And so Wall Street is just wrong long term. They may have the risk side of the equation right short term, but long term, they're just missing the forest for the trees. So that's what we specialize in, finding those individual stocks inside of sectors that are beaten down, where the consumer is loving what they're seeing and ringing the cash register.
This is an approach that can scare retail investors. It seems like a risk-on approach when you're looking at these beaten down stocks. But you guys have a really great strategy on this. And I know you both recently teamed up for a special report specifically talking about this kind of economy and this kind of market that we're seeing right now, where there are all kinds of opportunities, just like you said, and how to approach it from that contrarian view and hopefully profit off of what's happening in the market today. I'm going to pop up a link really quick if you want to look at that special report the two of these guys just put together and take a look at Jeff's contrarian approach to investing. You could scan the QR code or click the link in the description to check out that report from these two guys right now. But let's dive into the specific names of stocks that you're looking at and the sectors that you are bullish on right now, plus that one to avoid. I'm actually really excited to get into that one at the end of this video because the sector to avoid is very contrarian. I'm excited to hear your take on it. But let's start, Jeff, with that first sector that you are bullish on right now.
Sure. Well, I'll preface all of this by saying that nobody's going to like the ideas that I come up with. And that's what makes them contrarian, right? If everybody liked them, they'd be the popular ones and they probably wouldn't work. And if you just backtrack to the last time I was on your show, Bridget, we talked about 3 sectors that nobody liked. And I remember the comments were just horrible, but all of them have paid off pretty well by doing that. So I'm going to throw these out there again, and your listeners can do their own due diligence on it. But I love the idea of buying into the financial sector right now. I think the banks and the financial stocks are setting up well going into earnings season. They tend to hold up well into earnings season. And I think because they've sold off recently, that you now have an opportunity to pick up these banks and private credit stocks, in fact, at relatively lower multiples than where they've been trading before. So I think you have a short-term opportunity to profit off of that.
It's interesting you bring this up because the names Visa and MasterCard, those stocks both popped up on our radar maybe a week or two ago because they've been in such a downtrend. Would those two be included in kind of the financial sector downtrend that you're seeing right now?
Oh, absolutely. But the one I like better than both of those is American Express. I think American Express, from just a sentiment point of view, is just totally washed out. It's trading at multiples that it hasn't traded at for several years. I think it's down 20% or so since the start of this year, and it looks like a bargain to me. And I'll throw some other ideas out there too for your listeners. The private credit market. This is the ultimate in contrarian thinking. The private credit market has just been crushed this year. These are the KKRs, the Apollo Management, the Blue Owl, that sort of stuff. All of those are down 40 or 50% from their highs, and they're down mostly in 2026. And 2 weeks ago, all you heard, if you turned on the financial news networks, all you heard was negative headlines about the problems in private credit. And I thought, wow, it's interesting. Anytime CNBC or Bloomberg or Fox Business are all on the same page, I start to wonder how relevant that is and if it's not being exaggerated or maybe manufactured a little bit for ratings purposes. And if you look at the private credit market, these are basically companies that make loans. They're not banks, but they raise money, they hold assets under management, and they lend the money out to institutions. But most importantly is, as the private credit stocks have been falling, insiders of those companies have been stepping up and they're buying them. So I look at one of my favorite examples is KKR. It's trading down 35-40% on the year. It's at fundamental valuations we haven't seen in quite some time, about half the normal historic valuations. And the insiders of that company have stepped up and bought $5 million worth of stock over the past 2 months. It doesn't seem to me that the insiders would be doing that if we were in the midst of a crisis situation in the private credit market. So I think there's a really good opportunity in that. And we'll just expand that going out to the entire financial sector has been under pressure because of the worries of what's going on in private credit. So I think that's what's created that opportunity.
Yeah, I feel like, Andy, this is exactly the case that you just talked about, where Wall Street doesn't like the stock for whatever reason, but the fundamentals or what's actually happening behind the scenes doesn't necessarily fully support the downtrend that these stocks have had. So when you're looking at things from an options perspective, does the financial sector and what Jeff just talked about qualify for what you look at as an options person?
Absolutely, it qualifies. And, I love the financial sector just like Jeff does for the same reasons. It's beaten down. It feels like risk is the primary driving objective right now, which, suppresses valuations and so on. I'll say, when we look at our data, it's not a big bank. It's not, one of these private credit firms, but I'm really starting to like what I see from Robinhood, ticker symbol HOOD. What they're doing is exceptional. They have an unbelievable executive team that executes time and time again against the plan. This is a stock that we got into in the teens, and it ran up well over $100. Now it's pulled back very significantly. But when we look at the LikeFolio data on this, and we look at the consumer activity of people moving their 401ks, of opening credit cards with Robinhood, of establishing crypto purchases inside of Robinhood, et cetera. This is a company that is just a gravity well of consumer financial activity coming all under one roof that they will be able to monetize really, really well. So this is the type of setup that I love is, the stock got ahead of itself when Wall Street was greedy. Now it's pulled back when Wall Street is fearful to levels that I think are unjust. And at the same time, consumers are absolutely flocking to the offerings that this company puts out, and they have a history of executing really well. So that's a name I would put on everybody's radar right now.
The interesting thing is, if you look at Robinhood way back in September when it was trading over $100 a share, everybody loved that name. Everybody wanted in, and everybody chased it higher. Now it's trading well below those levels, and people are going to roll their eyes when they hear Andy talk about how he likes Robinhood. Fact of the matter is, Robinhood's a much better buy right now than it was back in September. The risk has been not completely eliminated, but it's definitely been wrung out of it. And the upside potential is a lot more significant than where it was back in September.
Yeah, this is a name we hear all the time from our viewers who are interested in the stock, who got in just like you said, Jeff, when there was all the headlines and all the buzz around Robinhood, that's when people got in, and now they're bleeding from this name in their portfolio. But I love the case that you're making, that there's a growth case now to look at adding this stock to your portfolio, because now there's actual upside ahead versus buying it when it's at the height of the buzz around the company. I do want to hone in on one thing you said, though, and that's the risk a little bit. I want to talk about broad sector. When we're talking about the financial sector, talking about Robinhood, these private debt companies that you were talking about too. Let's talk about the economic factors, the geopolitical factors that are causing a lot of the market turmoil right now. It seems like there would be some real risk when we are having so many different headlines talking about the interest rates and different things to do with the Fed's chair changing and lots of different economic, geopolitical factors. Does that add an extra element of risk to getting in on this sector when it's in this downtrend right now?
Well, that risk always exists. It's just the risk now comes to the forefront now because people are paying attention to that. So the reason the stocks have fallen over the past couple of months is because that risk is existing and people are recognizing that risk. So they're liquidating the positions in that. So the market is doing what it does. It's a discounting mechanism. So stocks sell off prior to bad news hitting it. Stocks rally prior to good news hitting it. So what you're experiencing right now is you're seeing the sell-off, taking the risk out with the possibility of maybe there's an economic recession coming, maybe there's a credit contraction or liquidity issue coming. It's already being reflected in the price of the stocks. So the S&P 500 at 7,000 back in January, there's not a lot of upside left to that, and there's a lot more downside. People weren't paying attention to it. Now with it 500 points lower, there's not as much downside. There's a lot more upside, but people are more fearful. So the fact of the matter is, it's a lot smarter to buy the S&P at 6,500 than it was at 7,000. So risk reward wise, if you look at Robinhood or you look at KKR, you look at any of these stocks that have been hurt in the financial sector, the risk has been wrung out of it. The headlines have always existed. The concerns have always existed. It's just what are we paying attention to? That's what's caused the price decline. It's discounting that potential in the market right now, which is what creates that opportunity.
Yeah, and I'll just add to that, I think if any one of us could say what Donald Trump is going to do tomorrow, we would be, the Nostradamus of our time, or what Iran is going to do tomorrow. We don't know that. But what Jeff Sings has got exactly right. We didn't know that in January either. But now we have more information and more risk has been priced into the stocks and hit the headlines. And so the risks were there the whole time. We just didn't pay attention to them as well as we are now. And maybe you can make the case we might be paying a little bit too much attention to the risk side versus the reward side.
That certainly was true in January, just as it's true today. What a great point, Andy. I love that. Let's get on to the second sector that you want to talk about today, Jeff, as one that you're bullish on, even though it's down right now.
Sure. I think the healthcare stocks represent a compelling value right now. Healthcare has been beaten up, mostly as a result of government spending cutbacks, some of the re-regulating in the sector, all that sort of stuff going on. So the market has once again discounted the possibility for changes in the business models for those particular companies. A lot of stocks in that sector are getting hit pretty hard. One I like is Molina Healthcare, MOH. Another one is Oscar Healthcare, OSCR. And I'll let Andy talk about his favorite because it's one of my favorites as well.
Yeah, I mean, if you hated Robinhood, just wait until this one. We're bullish on Hims and Hers Healthcare, ticker symbol HIMS. Again, for very much the same reasons. This is stock that's extremely beaten up. It has regulatory scrutiny surrounding it, circling it at all times. But the reason why that regulatory scrutiny exists is because they are disrupting the healthcare sector in such a massive way. And we see it in our consumer data every single day. More and more people downloading the Hims app, talking about the products or services that they're buying from Hims, talking about how much they love it versus the old way of going to their doctor and sitting in a waiting room for an hour and a half and then telling the doctor some embarrassing story. They're getting these solutions right from the palm of their hand, and they're loving it. The healthcare market in general doesn't love that Hims exists. but consumers do. And ultimately, we like to believe that where the consumer puts their dollar ultimately wins. And so that's why we like HIMS here. And yes, we like it even more down at these suppressed levels than we did at last fall's highs. It's the same type of stories we have with Robinhood. Every once in a while, you just have to say, yep, there's going to be some volatility in this. Yep, I'm taking some serious risk, but the upside reward is so much greater. It's so asymmetrical compared to the risk that it's worth a shot for part of my portfolio.
HIMS is such a great name to talk about. It's one that has come up for over a year on this channel with a lot of investors interested in the stock. But talk about a name that moves on headlines. This stock moves on any major announcement. We know they just had that major lawsuit close with Novo Nordisk, and they had a huge jump just a couple of weeks ago. And now they're on that downtrend again after jumping back up. But for you, when it comes to all of these different headlines, these different moves, regulatory issues, like you said, lawsuits, all of those different headlines and noise around HIMS and hers, do you let that noise impact your decision or thoughts about where the stock could go in the future? Or do you believe there's a use case no matter what headline might be coming at the moment?
For me, I've been around for a really long time, and I can remember when Amazon was hated because they were going to lose money forever, and nobody wanted to allow online transactions to be as big as they wanted it to be, to have these superstores online. It was headline driven for a very long time as well. Same with Netflix. When it first got started, they were hated for a long time. But what we pay attention to, instead of, I like to see the headline volatility as an opportunity, because what we're watching is where the consumer is going. What companies are attracting, or are those gravity wells for consumer behavior and consumer dollars? Because those don't change based on headlines unless it's a complete scandal. Underlying fundamentals that are driving the business forward for the next 2 years, 5 years can be extremely strong, while all the headlines and the Wall Street analysts are clutching their pearls, wondering, if there's a 10% drop underway. But the outsized opportunity is what we look at, and it's all based on where is that consumer going and how excited are they to be there when they get there. For Tesla in the past, Netflix in the past, Amazon in the past, it's worked really well. We see the same type of setup for Robinhood and for HIMS.
Yeah, Andy, I'm seeing a theme in the two stocks that you've mentioned here. Hood and HIMS are both big disruptors in their field. They're fully changing an industry. But Jeff, I'm excited to move into this third sector that we're talking about and start out with the topic of disruptors, because that fits in this sector that you are bullish on, even though it's continued to be in a downtrend pretty much all of this year. What do you think about disruptors in this third sector?
We're talking about the software sector. And the last time I was on, I talked about IGV, which is the exchange traded fund for the software sector, being one of my favorite stocks back then. I believe at the time it was around $78 a share, which is roughly where it is right now. So you could say for the past several weeks, the sector hasn't gone anywhere, but you'd be missing the point that I tried to make last time, was that I thought it was set up for a short-term rally that was so oversold, it was so hated, everybody was so pessimistic that it looked set up for a short-term rally. And IGV did in fact go from 78 to about 86, a rally of about 13% off of that. Using options, however, we were able to capture a 120% gain in about 5 days on IGV. So there are ways to do this contrarian type of trading using options to reduce the risk and generate much larger returns than you can off of the stocks. So now it's interesting because IGV is all the way back down to $78, $79 a share. And I like the setups in the sector. Again, I like some of the big names like Microsoft and Oracle, and everybody rolls their eyes when I say that, but those are some that I like. I like Figma, which is FIG, which is definitely a disruptor in the software sector. And so I think there's a lot of opportunities coming along the lines with that. Now, when I trade typically with a 2-week to a 6-week time frame. So whatever I say today is valid for up to 6 weeks, right? 6 weeks from now, the game's off, right? It's a different story. So oftentimes, whatever I'll present, I will change my mind on several weeks in, depending on what has happened in the market movement. But software, interestingly enough, had its nice little move, nice little rally, and it's come on back and it's giving us another opportunity to take another shot at the names in the sector again.
Yeah, that growth story that you talked about with using options on these stocks is a really interesting way for retail investors to look at gaining faster profits as an investor. A lot of times we talk to retail investors who are are just looking at good entry points to add to a long-term stock that they might be holding. But if you want to learn more about trying to use options, maybe for the first time or just trying to get better at this yourself, Jeff and Andy are both great teachers on this. And again, if you want to check out their special report that talks specifically about looking at these contrarian views and how to use options to really profit off of them, make sure to check out their report. I've got a QR code here or a link right in the description and in the comments here on this video if you want to learn more from Jeff and Andy on how to use options on this contrarian approach to investing. But Andy, let's get to you. What are some of the stocks that you are watching in the software space?
Yeah, I'll piggyback on Jeff. I think Figma is a very interesting opportunity here. I mean, you talk about completely beaten up since its IPO, but they are, again, a revolutionary product that ultimately benefits from the AI movement. And one of the things that we're seeing, it's an unbelievable revolution that's happening where, my son is now developing iPhone apps. He's never coded anything in his life, but the vibe coder revolution is very real. It's driving Mac Mini sales. These guys get out the credit card and they put down the money they need to get the tools in hand that they can build their business or their app or their idea. And now there's millions of people doing this, and Figma is a direct beneficiary of that. So that's one of those kind of consumer movements that we love to see and that we talk about. And Figma, I agree with, is right in the crosshairs of that. And just to go on the options side of things, I've been trading options for 25 years, and I still love Jeff Clark Trader because Jeff teaches me things about options and simplifies it in ways that I don't communicate as well as he does. So even if you've never done options before, or you're intermediate or even maybe advanced like me, you're still going to get benefit from listening to someone like Jeff because he sees it so clearly and makes it so actionable. So I really love that. It's not always about making that 20% gain a 100% gain. It's also on the risk side, how you can get into these positions and say, look, Figma looks very risky. Robinhood looks very risky. Yes, it is. So why can't I define my risk to $500 or $1,000 on this position instead of the whole share price? And that's something that Jeff is excellent at doing. So I encourage people to check that out. Even if you never thought you'd be into options, it's worth a look. And it could open up new possibilities for the way that you look at the market overall.
Yeah, Jeff, you are so good at making these things simplified. And that's why I have another question on software, because what you just talked about, Andy, is talking about the opposite view, a contrarian view of what people and the market seems to be looking at software stocks. The risk and the reason we're seeing these software stocks tumble is because they say that AI generation of these apps and of these different products is why software stocks won't be needed anymore. And yet you just made a case for Figma being needed because it actually benefits from people using AI to create their own apps and software and things like that. So let's talk about that concept, Jeff. I know you talked about it last time a little bit about that contrarian view about even though the market seems to think that software is not going to be needed anymore, it looks like you have a different view on that.
Well, companies have a history of pivoting, right? Anytime there's a major disruption in an industry, you change your methods. Think about last year, Google. Google was the worst performing of the Magnificent Seven stocks in May of last year. And it was because everybody thought that with AI, you're not going to need search engines anymore. Once that made its way through the investment psychology, Google all of a sudden became the best performing stock in the Mag 7 over the past year. Google outpaced everybody else by multiples. So now you're looking at AI taking over the software as a service space. All of a sudden, SaaS isn't going to exist anymore as an industry because AI exists. It's not going to happen. It's more conceivable that maybe we're exaggerating the potential for AI to do all of these things. And the companies themselves will step up and they'll create situations where they are still relevant, where they actually use AI to accentuate their products and enhance their services even more so they become even more critical for businesses to have. I think of ServiceNow being a good example of that. Go back to Figma. Figma is a very good example of that as well. So there are multiple situations where the baby's been thrown out with the bathwater, just to throw a cliche out there. So there's good stocks in that sector that you can find that are disrupting the industry. They're using AI to actually improve their business and create larger profits because of AI. So yeah, there's going to be some problems. There's going to be stocks that go away because AI has taken over. their main business. But there's going to be a lot more stocks that actually use AI to accelerate their business and accentuate the products that they have available for customers.
Yeah, and so I'll add on to that with just an analogy from the past. There was a point in time where the market was ready to throw Walmart to the wolves and say Amazon was going to win everything because there's a new digital economy and Amazon was going to win. And now, if you look at it, Walmart's one of the leading digital economy participants. They're growing faster than Amazon. They're taking market share from Amazon. They've pivoted, just like Jeff said. They had the balance sheet and the distribution to do that. They had the ability to be slow and then come out swinging. And so I think you're going to see that over and over again. When people say AI is going to kill software, it just rubs me the wrong way, because AI is software, and what it does is it makes software more powerful, more useful, and it's democratizing software just like Amazon democratized e-commerce. And so it just brings more participants into the game, and the winners are going to be even bigger than ever before. I just think this entire narrative is completely upside down.
Both really great examples, talking about the Google example and the Amazon killing Walmart example of how the market thought one way, and then these companies and these individual businesses proved the market very wrong. So a great contrarian approach, and I'm excited to see the contrarian view you have on this popular sector to avoid. This last one is also always so beneficial for investors to look at what to avoid just as much as what to look at getting into right now. So let's talk about the sector to avoid. And this is the sector that's making every headline right now.
Sure, and I'll get ready to pull the arrows out of my back as soon as I say this. Remember, last time I was on, early February, I talked about avoiding the precious metal sector. I said GDX looked like it had gotten a little far ahead of itself. And the comments were they were brutal. It's like, how can you possibly be bearish on gold given the macroeconomic outlook that we had? And it wound up to be correct. It was the right position to hold. Now I'm looking at the most popular sector in the market right now is energy. The oil and gas stocks have just been on an absolute tear for obvious reasons. And it's interesting because energy has gone from the worst performing sector in 2025 to the best performing sector in 2026. And all I'm saying right now, not necessarily bearish on the stocks. In fact, I think if we go out a year from now, many of the energy stocks will probably be even higher than where they are right now. My concern is over the next 2 to 6 weeks. I think the sector has gotten ahead of itself. I think there's too many folks rushing in, chasing it for fear of missing out. And FOMO is always a really difficult way to invest. And I think if you're doing that now in the energy sector, you're probably making a mistake and you'll regret it several weeks from now.
I think that's a really good timeline for viewers to look at. Long term, there still may be some growth ahead for energy, but in the short term, this is a time to really pay attention. So if you're thinking about getting into energy, maybe not a time to look at getting in. Andy, what are your thoughts when you're looking at options and looking at the energy sector right now? What kind of bets or what kind of stocks are you looking at specifically for options in the energy field?
Yeah, I think it ties together with our broader conversation of the stocks that we've talked about. They were the FOMO plays like energy is, 2 months ago, 6 months ago, et cetera. And then now they've pulled that back, gotten beaten up, and nobody likes them. And now the opportunity's there. I think the same thing could play out with energy. So I think now's the time to build your watch list of energy stocks and energy companies that you think could change the world. Oklo is one that we put on our watch list. If we get a significant enough pullback on that, they're helping build out energy infrastructure for these data centers that are going to continue to be built out at an incredible pace. When I think about it from a trader perspective or even from a longer term investor perspective, anytime I start getting FOMO into a specific sector, industry, or even a stock, what I like to do instead of buying it is put it on a watch list and maybe start selling puts well underneath the stock price so that I can collect premium until we get there. But if the stock gets down to where I think it would be disliked and I would love an entry, then I get the shares at that point. So from an options perspective, that's the approach I like to take is, yeah, this is the hot name right now. I'm not going to chase it, but I'm going to watch list it. And then if I have even more conviction, I might, sell some puts underneath that get me some income in the meantime and the opportunity to own the shares at a discounted price in the future.
Such a great conversation on a contrarian way to look at investing and hopefully profit from it too. Thank you both for your time today. If you want to check out that other interview we had with Jeff Clark back at the end of January and hear his contrarian approach on some of the stocks that were down at that point, make sure to check out the full interview here.